Hey everyone, welcome back to the channel. In today's video, we've got three big stories to cover. First, we're going to take a deep dive into S&P Global, one of the best long-term compounders out there. I'll explain why, despite a high valuation, I'm personally bullish and see growth accelerating in the years ahead. Then, we'll talk about Target, whose stock just dropped 10% after announcing its new CEO and reporting another quarter of falling sales. Finally, we'll wrap up with Hertz's new partnership with Amazon, which could be a big deal for Amazon's expansion into autos. So let's get started. S&P Global is one of those companies you can call a sleep well at night stock. It's not flashy, it's not a meme play, but it has an extraordinary track record of consistent growth, strong margins, and a proven ability to bounce back after downturns. This is exactly why some of the best investors in the world, like Dev Kantasaria's Valley Forge and Chris Hohn's TCI fund, hold significant positions in it. At its core, S&P Global has been a steady compounder, growing revenue around 6 to 8% annually with gradually improving margins. That formula has produced market-beating returns for decades. Whether you look at its IPO or the years following the financial crisis, S&P Global has delivered. Now, if we look at recent years, the stock has underperformed the broader S&P 500 since about 2018. Some analysts argue it's because of macro uncertainty. Others point to weaker segments like market intelligence becoming a bigger piece of the business, or simply that valuations got stretched. Honestly, it's probably a mix of all three. But here's my take. I think S&P Global's next growth phase is going to surprise people. Let's look at the most recent quarter. Revenue came in at $3.75 billion, up nearly 6% year over year, beating expectations by about $80 million. Adjusted EPS was $4.43, up 10%, and also ahead of estimates. Margins improved by 70 basis points. That's not hypergrowth, but it's steady, high-quality growth, exactly what S&P Global is known for. Breaking it down by segment, indices, revenue up 15%, operating profit up 16%. This was driven by a market recovery pushing assets under management in S&P-linked ETFs to all-time highs. Margins here are incredible at 71%. Mobility, revenue up 10% ahead of its planned spin-off. Margins climbed to 42%. This segment looks well-positioned to unlock more value once it's spun off. Commodity Insights, revenue up 8%, operating profit up 10%. This is one of S&P Global's most differentiated businesses thanks to its unique data. Ratings growth slowed to just 1% after a strong year in 2024, but this business is cyclical, and it remains a cash machine long-term. Market Intelligence, revenue up 5%, but more importantly, operating profit grew 13% as new leadership focuses on reigniting growth through sales optimization and cross-selling. So across the board, we saw strength, even if some segments grew slower. Others, like indices and commodity insights, delivered double-digit profit growth. When S&P Global gave guidance after the first quarter, tariff-driven uncertainty was close to peak levels. The S&P 500 was 16% lower than it is today, and GDP was down 0.3% quarter over quarter. This backdrop, naturally, mandated a cautious outlook for the remainder of the year. Of course, the macro backdrop improved sharply since, and S&P Global upgraded its guidance in the recent quarter. The company also raised its full-year guidance. They now expect revenue growth of 5 to 7% and EPS of 17 to 17.25, both higher than before. On the division level, the only segment that remained as is was Market Intelligence. Ratings was upgraded to 2 to 5% growth. Commodity Insights downgraded to 6.5 to 8%. Mobility upgraded to 7.5%, and indices upgraded to 8 to 10%. Notably, the two biggest upgrades were in ratings and indices. The latter is primarily due to the market recovery, and the former, I presume, is mainly due to a better-than-expected Q2 for billed issuance, especially the month of June. The way I see it, S&P Global has now set itself a high bar for the second half, and I doubt it will be able to deliver beat and raise, which I believe investors expect. On indices, the market is up 4% since the end of Q2, against comps that are 7% tougher for Q3 and 12% tougher for Q4. In ratings, spreads continued to narrow in the past months, while tariffs were back on in early August. It's hard to see a catalyst for a meaningful acceleration in Q3, but I do believe their guidance is reasonable. Here's the main sticking point: valuation. At about $556 a share, S&P Global trades at 32 times forward earnings, or around a 3x PEG ratio. Historically, that's expensive. But here's where I stand. I'm okay paying up for a company like this. Why? Because it has structural advantages that competitors can't easily replicate. Its brands, its indices, its ratings, these are entrenched in the financial system. And as capital markets activity picks up, as global investing expands, and as data demand accelerates, I see growth running closer to the high end of its 6 to 8% range, if not higher. Yes, analysts worry about whether it can keep delivering beat and raise quarters, but I think investors underestimate how sticky and resilient this business really is. Looking forward, there are several things I'm watching. The mobility spinoff could unlock shareholder value if priced correctly. Market intelligence has new leadership and could return to stronger growth with better execution. Commodity Insights continues to expand as energy markets and data needs grow. The upcoming Investor Day in 2025 could provide updated long-term targets. And if management signals even a modest acceleration above 8%, the market could re-rate the stock higher. So yes, S&P Global is expensive on paper, but it's also one of the best compounders in the market. Long-term, it has always delivered, and I don't see that changing. For me, it's not about timing the perfect entry multiple. It's about owning a high-quality business that compounds for decades. That's why I have high conviction in S&P Global, even if the market is cautious right now. Target shares sank about 10% after announcing both its Q2 results and a leadership change. On paper, the quarter wasn't terrible. The retailer beat Wall Street's expectations on earnings and revenue and reaffirmed its outlook. But sales and store traffic continue to slip, with comparable sales down almost 2% year over year. The bigger headline is leadership. Longtime COO and former CFO Michael Fidelki will take over as CEO in February, while current CEO Brian Cornell becomes executive chair. Fidelki says his priorities are restoring Target's reputation for stylish products, improving the customer experience, and better using tech to run efficiently. The challenge: annual sales have been flat for years. Traffic has been declining since January, and partnerships like Ulta are ending. Digital sales were a rare bright spot, up 4%. Overall, investors clearly see this as a transition moment, and with shares down 60% from their 2021 highs, Fidelki has a tough turnaround ahead. Hertz just announced a partnership with Amazon Autos to sell used cars online, and this is a big deal for Amazon. Customers can now shop Hertz's thousands of pre-owned cars directly on Amazon, sign the paperwork digitally, and pick up at Hertz locations. For Hertz, it's a way to get more visibility and boost profits from its retail sales business, which already moves hundreds of thousands of cars annually. For Amazon, though, this is another step deeper into autos. After launching with Hyundai last year, Amazon is now expanding into used cars, and Hertz is its first major fleet partner. This fits perfectly into Amazon's strategy. Make the platform a one-stop shop where customers can buy anything, now even cars. Over time, this could become a serious growth vertical for Amazon if it scales. For now, it's another sign that Amazon isn't just dabbling in autos, it's building an ecosystem around it. So to wrap up, S&P Global continues to be one of the best compounders, even if the market's focused on valuation right now. Target is entering a leadership transition while still struggling to win back shoppers, and Hertz's partnership with Amazon could mark a new era for Amazon's expansion into autos. Lots happening across these companies, and I'll be watching closely. If you enjoyed this breakdown, make sure to hit like, subscribe, and drop a comment on which of these stories you think has the biggest long-term impact. Thanks for watching, and I'll see you in the next video.